Welcome back to the deep dive. Today, we are tackling a piece of the financial world that I think for a lot of people just feels intimidating. I mean, it seems deliberately full of jargon. We're talking about the bond market.
It really does. It's the terminology that scares people away. But you're right, the concept itself is beautifully simple.
Right.
A bond is nothing more than a formal IOU. It's a loan. An entity, a corporation, a city, even a whole government takes out a loan. And we, the investors, we're the lenders.
We provide the cash.
We provide the capital. And in return, they promise to pay us interest, periodically, and then give us our original money back at the end.
And our mission for this deep dive is to give you that shortcut. We're going to unpack the core features, the risks you need to know, and those multiple, very confusing ways of measuring return.
And it's so relevant because understanding bonds is what helps you build a truly balanced portfolio. It's the grounding force.
It calms things down when stocks are going wild.
Exactly.
Okay, so let's get into it. The absolute fundamentals. How does one of these instruments actually work day to day, or I guess year to year?
It works on a really strict schedule. The borrower pays what's called an interest coupon.
Okay.
That's just the annual interest rate. It's a percentage of the bond's face value, or par amount. And those payments usually come once or twice a year.
And this goes on until
you hit the maturity date. That's the day the loan agreement ends. At that point, the original principal, that par amount, is returned to you, the investor, and the loan is all paid off.
Simple enough. Loan money, collect interest, get your money back. But the sources we looked at made it really clear that bonds aren't like stocks. Stocks are all pretty much the same unit of ownership, but bonds, they can vary wildly.
Oh, massively. And that's because of a legal document called the indenture.
The indenture, that's the blueprint, right?
That is the blueprint. It outlines every single characteristic, every restriction, every obligation for that specific bond. So you absolutely have to check, let's call it 6 key features in that document to really know what you're buying.
All right, let's run through that checklist. What's number 1?
Number 1 is maturity. This is just the lifespan of the debt. How long is your money locked up?
And that affects the risk.
Hugely. We usually classify them into short term, maybe 1 to 3 years. Medium term is 4 to 10. And anything beyond 10 years is generally considered long term. And the longer that maturity, the more volatile the price can be.
More time for things to go wrong. Okay, so that's the timeline. What's feature number 2?
Feature 2 is the coupon. That's the promised interest payment.
The reason you're lending the money in the first place.
Exactly. It's the coupon rate, sometimes called the nominal yield. And you just calculate it by dividing the total annual interest payments by the bond's face value. So a $1,000 bond that pays $50 a year has a 5% coupon, and that's fixed.
It stays the same for the whole life of the bond? Okay, on to number 3, and this is where it gets a little more complicated. Tax status. Why does it matter where the issuer is from?
Because the taxman always gets his cut, and it dictates your real return. Most corporate bonds are fully taxable. Federal, state, the works.
But not all of them?
No. And here's the game changer. Government bonds, and especially municipal bonds, we call them munis, they can be tax exempt.
And that's a huge deal. It means a lower interest rate on paper might actually put more money in your pocket.
Precisely. A tax-exempt bond will almost always offer a lower coupon. So you have to do a quick calculation called the tax equivalent yield to compare it properly.
To make it apples to apples.
Exactly. If you're in, say, a 30% tax bracket, a muni bond offering 4% tax-free is like earning 5.7% from a taxable bond. That difference is massive.
That really clears it up. Okay. Feature 4, callability. This sounds like an option for the issuer.
It is. It means the borrower, the issuer, has the right to pay off the bond before the maturity date.
Why would they do that?
Refinancing. It's all about interest rates.
Mm-hmm.
If market rates drop a lot, they can call back their old expensive high coupon bond and just issue new debt at the new lower rate. It saves them a ton of money.
So that's great for them, but kind of terrible for you as the investor.
It's a major risk because now you have your money back right when interest rates are low and you have to find somewhere else to put it.
You won't get as good a return.
Not even close.
Yeah.
That's why callable bonds have to offer a slightly better coupon rate up front. It's the trade-off. They're paying you for taking on that risk.
Okay, that makes sense. Feature number 5 is security status. Is there any collateral?
Right. This tells you where you stand if the company gets into real trouble. Secured bonds pledge specific assets as collateral.
Like what?
A classic example is a mortgage-backed security, an MBS. It's secured by the titles to a pool of homes. If there's a default, those assets are sold for the bondholders.
And the alternative?
Is an unsecured bond, also called a debenture. It's only backed by the company's general promise to pay. It's much, much riskier.
Got it. And that brings us to the last one, number 6, liquidation preference. This sounds like the seating chart on the Titanic.
That is a perfect analogy.
Yeah.
Who gets paid first when the company sinks? There's a very rigid order. Senior debt gets paid first, always.
Then what?
Then comes junior or subordinated debt. The money trickles down. Stockholders, the owners, they're dead last. They usually get nothing.
So why would anyone ever buy junior debt if senior debt exists? Is there a premium?
Absolutely. Because you're further down the payment ladder, you take on more risk of not getting paid back in full. So, to compensate you for that, junior debt has to offer a higher interest rate, a better coupon,
It all comes back to risk and return.
every single time.
Okay, let's switch gears a bit. We've talked about the mechanics, now let's talk about the borrowers. Who are the main issuers of all this debt?
We can really group them into 3 big categories. First, you have corporate bonds. These are issued by private companies, everyone from Apple to a tiny startup that needs to expand.
And with corporate bonds, the yield is all about how risky the company seems.
Directly tied to it. The higher the risk of default, the higher the yield they have to offer. This is where you find the famous junk bonds.
The highest risk, highest return corner of the market.
Yeah.
And fully taxable.
Fully taxable. Then our second category is sovereign bonds, issued by national governments. For us in the U.S., that means treasuries. T-bills, T-notes, T-bonds.
Right, or if you're in the UK, they're called gilts.
Exactly. And because the U.S. government is seen as having basically zero default risk, treasuries are the benchmark for safety.
Which means they usually offer the lowest yields.
They do. But they have that unique tax status we mentioned. They're exempt from state and local taxes, which is a nice little bonus.
And the third group.
That's local government financing. Municipal bonds or munis.
These are from states, counties, cities.
Right, to fund public projects. Schools, roads, bridges, you name it. And their big appeal is their tax status. For investors in high tax brackets, the income from munis often isn't subject to any federal tax. It can be incredibly efficient.
So moving on to risk. A lot of people hear bonds and they just think safe. But they're not risk-free, are they?
Not at all. There are 3 critical risks we have to understand. And the first one, especially right now with all the central bank activity, is interest rate risk.
Okay, let's unpack this slowly. Everyone hears about the inverse relationship between rates and prices, but why does that happen?
It's just market competition. Imagine you own a brand new $1,000 bond that pays a 3% coupon.
Okay.
Then tomorrow, the Fed raises rates, and new bonds, just like yours, start paying 5%. Now, if you try to sell your old 3% bond for $1,000,
No one's going to buy it. Why would they? They can get 5% on a new one.
exactly. So to make your 3% bond competitive, its price has to fall. It has to drop low enough that the return a new buyer gets is competitive with that new 5% rate.
So rising rates always mean falling bond prices.
Always.
Yeah.
Seesaw. And that risk gets much, much bigger the longer the bond's maturity is.
That makes perfect sense. Okay, what's the second major risk?
That's credit or default risk.
Yeah.
This is the simple one. The risk that the issuer just goes bankrupt and can't pay you back.
They fail to make an interest payment or they can't return the principal.
Right. For a corporate bond, you have to look at the company's financial health. Is its cash flow enough to cover its debt? The shakier it looks, the higher the risk.
And the third risk, this takes us back to a feature we already talked about.
Yes, prepayment risk. This is the risk tied specifically to callability. The scenario is simple. Interest rates have plummeted. The company calls your bond back.
And you're stuck. You get your money back, but you have to reinvest it in a much lower rate world.
Your income stream just took a big hit. It's not that you lost your principal, but your return potential is damaged.
So how do we as investors judge that credit risk without digging through every company's financial statements?
We don't have to, thankfully. We can rely on the rating agencies, S&P, Moody's, Fitch. They assign bond ratings that tell you about the quality of the credit.
It's like a grade for their ability to pay their debts.
It's exactly that. The highest quality bonds are called investment grade. That's AAA down to about BBB on the S&P scale. Very low default risk.
And below that?
Below that, you get into speculative bonds, which everyone knows as junk bonds. They offer higher yields, but they come with way more volatility and a much higher chance of default.
Got it. Now, some companies don't get rated at all, right?
They don't.
Mm-hmm.
Sometimes it's a cost thing for smaller firms. In that case, the entire job of assessing the credit risk falls on you, the investor.
Okay, let's tackle the final piece of this puzzle, and it's maybe the most confusing. Bond yields. Why are there so many different ways to measure the return on a bond?
Because each one is trying to answer a slightly different question. A bond can be bought at a discount or a premium. It can be called early. It can be held to the end. One single number can't capture the return for all those scenarios.
The one you always hear about is yield to maturity, or YTM. What's that actually telling me?
YTM is the big one. It's the gold standard. It estimates the total return you'll get if you hold that bond all the way to its maturity date. But there's a huge asterisk.
Uh-oh.
The calculation assumes that every single coupon payment you get is successfully reinvested at that same YTM rate.
So if the YTM is 5%, but rates drop and I can only reinvest my coupons at 3%, my actual return is going to be lower than the YTM I was quoted.
Precisely. That reinvestment assumption is key.
Yeah.
The calculation is complex, so people mostly just use financial calculators or software for it.
Okay, what about a simpler one? Current yield.
Current yield is great if all you care about is the income the bond is generating right now relative to its price.
Yeah.
You just take the annual coupon payment and divide it by the bond's current market price.
So you could compare that to a stock's dividend yield.
That's the perfect use for it. But it has a major weakness.
Which is?
It completely ignores any capital gains or losses. If you bought a bond for $900 and you get $1,000 back at maturity, the current yield pretends that $100 gain doesn't exist.
I see. And then there's the simplest of all, nominal yield.
That's just the coupon rate. Annual coupon divided by par value. It's really just a reference point for calculating the other yields. It's not a true measure of your return unless you bought the bond for exactly its par value.
And finally, 2 for special situations, yield to call and realized yield.
Right. Yield to call, or YTC, is critical for callable bonds. It calculates your return if the bond gets called on a specific date instead of held to maturity. It helps you see if that higher coupon is worth prepayment risk.
And realized yield.
That's an estimate. You need it if you plan to sell the bond before it matures. You have to project what the bond's price might be on the day you plan to sell it.
Before we wrap up, I want to quickly touch on 2 other bond structures. First, the very popular zero coupon bond.
Zeros are super straightforward. They pay no periodic coupons at all.
So where's the return?
You buy it at a deep discount to its face value. The difference between what you paid and the full par value you get back at maturity is your interest. It's all calculated in. People like them because there's no reinvestment risk to worry about.
And the second one is a hybrid, the convertible bond.
Right. It starts life as a normal bond, paying interest. But it has an option built in that lets you, the holder, convert the bond into a certain number of shares of the company's stock.
So you get the stability of a bond, but the potential upside of a stock if the company does really well.
That's the appeal. You get the best of both worlds, in theory.
So we've covered a lot of ground. What does this all really mean for the listener?
I think the key takeaway is this. Once you get past the terminology, maturity, coupon, security, all of that, you realize the bond market is driven by the exact same thing as any other market. It's all about those familiar risk-return trade-offs.
It's just a new vocabulary for the same game. You now have the tools to look at any debt instrument and understand what you're actually buying. And to put it all in context, here's a fact that I think surprises a lot of people. The global bond market is actually much, much larger than the global stock market.
It's a phenomenal scale. So let's leave you with one final thought to tie some of these concepts together. We know that longer maturity means higher interest rate risk. So with central banks around the world hiking rates, how does that change your risk assessment between, say, a 3-year short-term treasury bond and a 15-year long-term corporate bond, even if they're both investment grade?
Which one's price is going to get hit harder if rates keep climbing? That's your application challenge. Thanks for diving deep with us. We'll catch you next time.